housing. Bluebay Asset Management CIO is with us this morning. I'm pleased to say good morning to you then, Mark. Thanks very much for joining us. You make the point ahead of our conversation today in your notes that there's still a lot of liquidity around, plenty of cash then to buy any dips. Is that what we're seeing this morning? How convinced are you by the positivity we're seeing in Asia and into futures this morning here in Europe?
Yeah, well, I think it's a calm start to the week, actually. I think what we're seeing is, the news over the weekend that actually Jackson Hole is no longer going to be an in-person meeting. It's going to be in virtual format. If anything, maybe sort of taking a bit of the sting out the tail for what could have been discussed at that particular meeting. I think investors will jump to the conclusion that it's not going to be a very substantive discussion addressing a lot of new information, given that it will just be in virtual format. So with this sort of maybe the fear that something new could happen at Jackson Hole, which could rile equity markets, it's not surprising to see sort of volatility coming off and markets sort of starting the week in a fairly sort of upbeat, sort of benign fashion, particularly with Asia coming through a little bit better this morning.
That's an interesting take then on the down. You see it as a downgrading of the relevance, I suppose, or the significance of Jackson Hole. Then the fact it's going to be more. It's going to be a virtual summit now. Mark, what do you make of the Fed's reaction function to the Delta variant right now? We heard some comments at the tail end of last week from one Fed official who'd been previously prepared to countenance some taper talk in the September meeting, and now saying he's open to delaying that. Do you think that the Fed is minded to push conversations later into the year around tapering because of the spread of the Delta variant, or do you think they're just not going to be put off course by that?
Yeah, look, I think the fact that we have a bit of uncertainty will sort of play into the hands of those who just want to wait a little bit longer. It could have been the case that we saw a taper announcement in September. This could now be sort of pushed back towards November. I think maybe the other interesting element to this will be we could get a somewhat later taper, but if all goes well, the period of the taper could actually be a shorter taper. So I wouldn't be at all surprised. I continue to look for the idea that taper, as it comes, can actually be completed by the middle of 2022, and you can still see higher interest rates before the end of next year if the economy continues to perform on the track that we're looking for. But generally speaking, in this particular moment, we almost have this tussle between the taper and the delta in the two sort of forces driving markets. And in the short term, delta is the one that's in the ascendancy. But I do think at some point we'll be looking beyond the crest of the delta wave. And indeed, in that light, it's encouraging, obviously, to see states like Florida, which have been worst hit by delta. The daily infection rate looks like it's peaked out now over the course of the past week. So the same as we saw in India, as we've seen in Europe, this wave does hit hard, but it does tend to peak, and hopefully we'll be looking beyond that before long. But just at the moment, the Fed needs to be in no rush.
The Fed needs to be in no rush, and yet you do think, Mark, that the first move up in interest rates could come at the end of next year. That doesn't seem to be the median view. Just looking at dots go, there are Fed officials who do see hikes by the end of next year, but there seems to be the median view seems to be that those will come in 2023. What's the risk, do you think, to your view at this point?
So obviously the risk to the view that I'd be putting forward is that actually growth disappoints next year. Inflation comes out sort of lower than I've been projecting. I've thought that inflation, although some of it's transitory, we will see some lasting pickup inflation, and inflation would remain well above the Fed's target, at sort of north of 3% perhaps during the course of next year. But I would sort of voice at this point, as long as we're able to successfully move beyond COVID in the quarters to come, I would sort of reiterate the point that we've got a whole load of fiscal stimulus currently being discussed. That's going to be sort of giving a further lift next year to growth prospects. Also, the other thing that you need to think about in terms of projecting the economy is if you look at real rates today, if you look at financial conditions indices, these imply a lot of stimulus still hitting the economy. In many respects, we're actually hitting the economy with more stimulus today than we were 12 or 18 months ago in the very beginning stages of the pandemic, when markets were in a very difficult state. And to think that we're delivering the same amount or more accommodation now than we were then, I think speaks to me on a forward-looking basis that growth is going to continue to run pretty hot, and interest rate sensitive sectors of the economy should continue to do pretty well. We look for housing to do well. We look for business investment to pick up. We think the labour market is going to recover. If anything, there's shortages of jobs or shortages of workers, I should say, in some sectors. We see this feeding into inflation, into wages. And so I think that there is every reason to believe that we are going to be on a course where the Fed is going to be normalising policy perhaps sooner than many would currently expect, faster certainly than implied by the most recent dot plot.
Okay, Mark, thanks very much. Stay with us. Mark Dowding, Bluebay Asset Management.